Assalamualaikum and salam sejahtera. Okay, our group will present about audit of inventory. My name is NAJMA dan BINTI NAWAWI and I will start the presentation by introduction. Inventory refer to the current asset held by a company comprised of good of merchandising entity acquired or produced for the selling purpose. In manufacturing sector, inventory may be referred to maybe one of the three phases, which is raw material, work in process, and finished good. Audit of inventory is a method or a process of checking the financial reports against the actual inventory. In the inventory balance is track of the balance sheet of the current asset value as well as the audit discusses for a unique statement relating to the account, which is existing, right, valuation, and completeness. For existing, there is their inventory. For the right, does the audited entity really own it? And the valuation, does the price represent a benchmark in the real world? And the completeness, last is the completeness. Does it contain all items should be counted as the inventory? Okay. Next, I will pass to the next presenter. Thank you.
I am MUNIERA and I will explain about audit objective and nature of inventory. First of all, there are four main audit inventory objectives. The first is verifying existence. An auditor reviews the company plans and procedure for counting inventory and often physically observe the actual counting methods to determine efficiency. To verify the physical inventory counts, the auditor may randomly select samples from the warehouse or storage area and locate them in the count records. Second is examining accuracy. Statistical sampling is one method businesses use to count inventory. The auditor needs to determine whether the statistical methods would produce the same result as a complete physical count. Next is ascertaining ownership rights. An inventory audit establishes that all inventory recorded by the business actually belongs to the company. For example, the auditor may reconcile purchase orders and vendor invoice with cancelled check to ascertain whether the inventory has been purchased. Last one is evaluating realizable value. The auditor will match the inventory counts to record in the general ledger to ensure that the values are correct and conform to generally accepted accounting principles. The auditor will need to check the quality of products and items in inventory and verifies that excessive or damaged products are accurately listed at realizable value. Apart from that, the key issues are divided into three components, which are transaction objective, balances objective, and presentation and disclosure objective. Transaction objective consists of occurrence, completeness, accuracy, cut-off, and classification. Auditors need to verify on whether the transaction of buying and selling of inventories did actually occur or not. The records also need to be complete. For example, if there is a record of buying, there need to be some receipts as evidence. The accuracy of the records is important because auditors need to check whether stock count amounts similar to records or not. Then cut off means whether the amount is in recorded in correct accounting period or not. And lastly is classification, which means is the inventory classified correctly as the raw material, finished good, or work in process. Balances objective consists of existence, right and obligation, completeness, valuation, and allocations. Existence means any estimate of inventory contained in the financial statement carries the tacit assumption that such inventory remains as specified at the end of the accounting period. The declaration of life refers to all assets or liabilities contained in a financial statement. Furthermore, the declaration of rights and responsibility is a fundamental confirmation that a company making a statement has all inventories found in the financial statements. Assertion that all items found in the declaration within a particular accounting period are included and detailed in the financial statements. Accurate inventory appraisal notes that an inventory is valued in line with guidelines laid down by the accounting boards, where a cheaper cost or net realizable stock value needs to be appreciated. Finally, the objective for the presentation and disclosure include events, right and responsibility, completeness, definition, comprehensibility, specificity, and evaluation. The affirmation of reliable result and appraisal propose that the forecast supplied in the budget statements are correct and are based on reasonable appreciation and an adequate estimation of assets. The assumption that incomes on the financial statement of a corporate remain as shown as at the close of the accounting period protected by the financial accounting statement. Furthermore, the transaction contained in the financial statement completeness means that all transactions included in the statements happened during the reporting period covered by the statement and is included in the statements. Next, the definitive declaration of financial reporting is sent and communicated. This ensures that pertinent facts and disclosure are included in the statements of a corporation and all the material included in the statement is fair and easy to understand. That's all for audit objective. Now we go to nature of inventory. The inventory consists of 4 stages: raw materials, work in process, finished goods, and resales goods. If a dealer buys goods on the inventory, the cost of the goods sold reduces the value of the inventory count. The accountants must select a method that suits the nature of the sales for commodities that cannot be traced separately. Entity may do a physical count at end of period and compare to inventory records. Entities that maintain comprehensive inventory records may use the record as the basis for determining both the quantity and the value at the ending inventory. Auditors are supposed to do this. First is test of control over recording and maintaining inventory records. The investment in the stock of a business is typically high and can consist of several goods that can be stolen and sold quickly. If the stock comprises mostly raw materials, it must be tracked to ensure that the manufacturing process using it do not lack materials. This means to deter fraud or to ensure the output does not go without an input. You have to enforce a set of controls. Second is observation of evidence from the existing inventories. When the auditor reviews their client's counting practice, the auditors can concentrate on 3 main areas including before counting, and count procedure. These processes are necessary to ensure that any mistake is detected and financial statement expressed in the inventory quantity report. Last one is verification of both cost and net realizable value of inventory. If an organization buys a stock, added expense can be paid for the collection or selling phase. The cost of inventory management are referred as a inventory holding cost. Suppose, for example, a manufacturer orders a large section of luxury furniture as a stock, and the firm must install a display case and employ a buyer to transport the furniture carefully to the buyer's home. The added expense are minimized by the net realizable value measurement purchase price. That's all from me. Thank you.
Hi, my name is FIRDAUS and my metric number is 261034. I will be presenting accounting system and control activities. So the main point of this subtopic is to say that every company should have high and adequate internal control by maintaining records of inventory transaction. There are 2 records of inventory transaction, which is record for physical inventory and record for inventory costs. These control activities are performed in order to achieve the audit objective of existence, completeness, proper valuation, and proper ownership. There are 4 steps in maintaining record for physical inventories, which is record the movement of goods into inventory. Secondly, record the movement of goods from inventory. Next, record the transfer of inventory. And lastly, comparison between inventory count and inventory records. So first, let's go one by one. Record the movement of goods into inventory. This process starts when inventory department receives goods from supplier. They will prepare good receipt note or GRN to validate the receipt of goods. For your information, goods receipt note is a document which is used to validate the receipt of inventory from suppliers, and the GRN is used by accounting department to check status of goods and verify invoices before making payment. records the movement of goods from inventory. This process starts when inventory department receives good requisition from requesting department or sales order from sales department. The inventory department then will determine the amount of inventories need to transfer out and then record the key information of the inventories transfer, such as the quantities of the inventories and the status of the inventories transfer. Next, the goods are transferred out. Records inventory transfers. This process starts when requesting department prepares good requisition or sales orders and send it to the inventory departments. Remember, good requisition document should be pre-numbered and properly approved by authorized personnel. The inventory departments then will record key information of goods requested. When goods is received by the requesting department, they will update to the inventory department and inventory departments record the status of the goods. Lastly, comparison between inventory count and inventory records. A company will need to compare between the physical count of the inventory and their inventory records periodically, such as annually or monthly, depend on the company. So the purpose of the comparison is to ensure the consistency and reliability of the records, testing the effectiveness of procedure implemented, ensuring accountability for custodianship and record keeping, and detecting any error of inventory quantities. In this process, a company will compare between stock take and inventory records. Stock take means an assessment and record of the amount of the inventory held by a business, which means they need to count the inventory they have at the time. Stock taking process. Firstly, the company will assign and communicate responsibility. The company will assign an independent person who does not have any responsibility toward the inventory to do the counting. Next is preparation. At this time, all movement of inventory are stopped. Next is identification. The person who will count the inventory identify which inventory need to be counted, and then the counting begin. After the counting finish, a double check is done and all inventory are recounted to avoid any error. Next is the clearing process, which is every inventory that has been counted will be marked so that there will be no uncounted inventory or double counted. The result of the inventory will next, the result of the counting will next be recorded and cut off will be done. Cut off means that to record the last three numbered GRN, bill of lading, and inventory transfer requisition issued to ensure that the count is compared with inventory record based on the same document. The second part of maintaining inventory record is maintaining record for inventory costs. Every company should maintain an appropriate cost accounting system to ensure proper costs are recorded in inventory record. They need to have proper calculation and effective control in order to ensure that inventories are recorded at correct value. This is very important, especially for manufacturing company, because their inventory costs involve the process of converting raw materials into finished good, which also include the labor cost and overhead costs. But still, merchandising company should also need to have an appropriate cost accounting system too. Also, every company in Malaysia should develop an accounting policy in which the company should record inventory costs consistent with the requirement of MFRS 102 inventories. And that concludes my presentation. I will pass on to the next presenter. Thank you.
Hello, Assalamualaikum warahmatullahi wabarakatuh. My name is Harith Zafran bin ZULRAIDI. My matrix number is 261040. And I would like to present about developing audit plan. First of all, what is audit plan? Audit plan is a guideline It works as a guideline for an auditors before they audit a company for inventory. And it has a 4 phases of the audit plan. The first one is understanding the entity to identify inherent risks. The second one is obtaining an understanding of internal controls over inventory. The third one is assessing risk of material misstatements. And the last one is designing further audit procedures. So we will go for the first one. Understanding the entity to identify inherent risks, which is an auditor. Why auditor need to understand the inherent risk? Why need to understand the entity? Because understanding provide a frame of reference within which the auditor plan the audit and exercises professional judgment on the evaluation and respond to the risk. So it makes the auditor to know the entity, to know the company and how the environment works at the company, because every sector have a different environment and different operation, so they can apply the same method into every company. The next one is obtaining an understanding of internal controls over inventory. So the first, obtaining an understanding of internal control is understanding of internal control is important for auditor to ensure there is no misstatement on the procedure. The procedures such as purchasing, receiving, issuing goods and from sales cycles and purchasing. Furthermore, the auditor also should truly understand on the control over inventory costing, which is a perpetual inventory, records and physical protection of inventory. The next one is why auditor need to understand internal control, because it works to provide an extra reference tool for the auditors itself to identify and assess operating controls such as how the entity determines this ending inventory. Usually, if the company only depending on physical inventory count, and different approach need to do it. So the approach is like, we call it predominantly substantive approach to retrieve the evidence from the inventory. So they need different ways. And next is the auditor also may observe by making inquiry for the details from the management to check the reliability. So this is from this situation, the auditor itself will ask the management about the information on how the transaction going, about the disclosure, the account, and all of information about the internal control of the inventory. And the third one is assessing risk of material misstatement. This works as audit evidence in order to support the relevant assertions to identify material misstatement. Usually, this audit procedure are practicing to check an error, fraud. To avoid from error and fraud. And the auditor should have adequate understanding of the company and its environment. And the next one is the auditor may have determined the inventory is exposed to the risk of overstatement. Usually, the company, they make overstatement for their benefit. For example, if they usually make an ending inventory higher, overstate the ending inventory. This is because they want to make it on the financial statement, their asset have a stable asset. This is because they want to attract the potential investor when they have a really good asset. And in other situation, they will also overstate the cost of goods sold. Is because when cost of goods sold is higher, the inventory is lower, and it's gonna make our gross profit lower. So it will avoid the higher tax deduction. And then next is the auditor should also consider the significance and the likelihood of material misstatement for each identified risk, which is the same as what I said before. And the last one is designing further audit procedures. Further audit procedure comprise of tests of control and sub-testing procedures. And the next one is control tests are audit processes conducted to assess the procedural performance of control the appropriate stage of assertion, which is control, which is the performance like to identify the control mistake. They want to check if the management have make a mistake or not. And the next one is the aim is to collect the data for the reliability of control in an analysis of the internal control of financial statements, which is, as I said before, the view of the auditors concern the efficient and prompt internal audit of financial statement by the company. So they collect the data and get the enough information to make an audit for the financial statement because they doesn't want any error or any fraud in the financial statement. Lastly, the financial reports of the organization are a significant source of audit data in addition to other sources inside and outside the agency. And this is used as the evidence. Usually, the last one, the further audit procedure, is more likely about the evidence of the company as a inventory to see on the financial statement. So that's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh, and hello fellow friends and dear Dr. Muhammad Naimi. My name is AHMAD FADLI IBRAHIM, matrix number 261037, and now I will be presenting on further audit procedures. Further audit procedures can be separated into two, which is test of control and substantive procedures. So the purpose of performing further audit procedures would be to provide a reasonable basis for an opinion on the audited financial statements. Next, to respond to the risk assessed from the misrepresentation of the financial statements and the level of assertions to the audited financial statements. Then, to assess the adequacy and appropriateness of the audit evidence obtained. Move on to the test of control. The main purpose of conducting this test is to obtain the sufficient evidence and to observe whether the function of the inventory records fulfill its purpose or not. Move on to substantive procedures is to obtain evidence on the existence and valuation of inventory. Auditors must perform substantive procedure. Then move on to the test of control that can be divided into two, which is test of design effectiveness and test of operating effectiveness. For test of design effectiveness, meaning that an understanding of the information system and internal controls on inventory records will be used by the auditors to understand the function of maintaining inventory, to determine the necessary controls and possible material misstatement. Then, the auditors are able to identify the lack of necessary control. They will make a preliminary assessment of control risk. An important note, auditors should not only rely on the ND inventory records, but should be relying more on the substantive testing if the risk is high. Moving to the test of operating effectiveness, inventory records are usually vulnerable to overstatements. So to counter this problem, auditors should perform this test to prevent or identify overstatements that might occur. Some procedure for acquiring the inventory evidence in this test will be reperformed, observations and watching documents. The auditors will make a final assessment of evidence obtained based on the procedures that I mentioned earlier to test control over the inventory records. Also, it is important to note that if the number of substantive procedures performed is high, then the level of control risk also will be high. Moving on to the three types of substantive procedures, which are analytical procedures, test of detail of transactions, and test of detail of balance. For the first procedures, the analytical procedures, this procedure is designed to conform with expectation, and this procedure provide assurance that the data used in calculation are fair when the calculated ratio is in line with expectation. Then the test detail of transaction is to confirm with the test of balance, and usually performed during an interim audit and in the form of a dual purpose test. Later, the cut-off test on inventory movement must be performed also by the auditors. Moving to the last test of detail of balance. So to obtain evidence of existence and inventory evaluation were concerned by this test. So I will give some example regarding to the financial statement assertions in this test of detail of balance. Beginning with the existence assertions, so the procedure will be selecting any random sample of asset reported in the inventory record during the inventory count and approve with the warehouse to verify whether the asset is available or not. Then for the right and obligation, the procedure will be justify that any third party goods are not included in inventory records and counts during inventory calculation. Moving on to the completeness, the procedure will be obtain a copy of the fully listed inventory and approve on the total volume as stated within the ledger and financial statements. Last but not least, valuation and allocation. The procedure will be select any sample items within inventory in the end of the year, then justify on cost of each record with new purchase invoice and make sure that costs are stated accurately. That's all from me. Thank you.
Okay, for the conclusion, external auditor should consider the business activity of an inventory transaction. It will help the auditor to identify the required internal process of inventory transaction. Actually, the organization should set up the internal inventory management system to prevent intentionally or unintentionally false statement. Inherit the problem related to the false statement of life accuracy or valuation and allocation of inventory. Audit process and substantial balance testing will be carried out the stage in order to provide the sufficient audit procedure that the inventory will be fair documented, and the transaction test will only be carried out if the final inventory is determined in whole or in a part of reference or to perpetual inventory record. And it is important to carry out audit in order to maintain the inventory accuracy, recognize the shrinkage, and guarantee that have enough stock in the certain time. Okay, the auditor will take the precaution to keep the company inventory safe and stable without the company needing to do any consuming on work by their own. Okay, that's all from us. Thank you.